Could the dragon's roar be turning into a whimper? As we peer into the heart of Asia, we find China, the world's second-largest economy, wrestling with a myriad of economic troubles. From the real estate crisis to power shortages, the economic giant seems to be facing a significant slowdown. But what does this mean for the rest of the world? The property market in China, a significant pillar of the economy, accounting for about 30% of GDP, has been cooling off after years of oversupply. Evergrande, a Chinese real estate conglomerate, is symbolic of this crisis, with its massive debt exceeding $300 billion. And it's not alone. Other developers have disclosed cash flow issues and potential defaults. These troubles stem from a sustained decline in residential property demand in China. Yet the majority of new properties are still sold before completion, leading to an array of unfinished projects. The real estate debacle, however, is just one piece of the puzzle. China is also grappling with a power supply crunch due to a shortage of coal supplies, tougher emission standards, and high demand from manufacturers and industries. This power supply issue is seen as an even bigger threat to the economy than the real estate crisis, leading to widespread power shortages and factory shutdowns. But what does this mean for the global economy? Commodity exporters such as Zambia and Australia will be hit hard as China's reduced demand for oil, copper, nickel, zinc, and iron ore will impact their economies. Germany's economy has also felt the shockwaves of faltering demand from China. Western companies that rely on China for revenues such as Tesla and Qualcomm face significant challenges. Yet the overall global impact may be somewhat diluted. Sales to China account for only a small percentage of most international businesses' total sales. Moreover, as the rest of the world experiences better than expected growth, this may provide a buffer against the economic tremors from China. In a worst-case scenario, a property meltdown in China could have global repercussions, causing asset prices to fall and rich world currencies to rise. Under this scenario, British GDP could drop by 1.2%. A prolonged slowdown in China could lead to reduced overseas investments and loans, impacting countries that heavily rely on Chinese funding. In conclusion, China's economic troubles not only pose a significant challenge to the country itself, but also have far-reaching implications for the global economy. From influencing commodity prices to impacting global GDP and investment patterns, the dragon's economic health is of global concern. So as the dragon battles its economic woes, the world watches with bated breath, for the ripples of this struggle will be felt far and wide.